All right, this is Nick Reese here. I'm about to go through my updated S&P 500 chart book called the U.S. Equity Market Chart Book. So here we have the indicator that gives us an idea of where the future annualized 10-year returns might be, and given how large the weighting is towards equities in terms of overall U.S. securities, if history is any guide, might suggest that the subsequent 10-year returns going forward on the S&P 500 on an annualized basis might be close to zero. There is a pretty wide range here historically, so to be more realistic, I would say that range is somewhere between plus 5 and minus 5% on an annualized basis over the next 10 years, just based on the historical analysis. All right, then in terms of LEIs, the LEIs continue to trend higher, which historically has been supportive of stocks. The earnings backdrop, the earnings came out very strongly for Q1, and the earnings growth projection, consensus projection, according to the FactSet data, is for 2018 calendar year earnings growth to be 19.7%. That's higher than what the earnings growth forecast was at the time of the last high in the S&P, which was on January 26th. It's also higher than where it was last month. It was at 19.2% projected growth for the calendar year 2018 in last month's report. So the realized and expected earnings continue to trend higher in the S&P, which is generally a positive for the stock market. One word of caution is that as the expectations get higher and higher, they become tougher to beat, and so that's something to keep in mind, that as these expected earnings of 19.7% are very good in a sense, but that also means that the bar is high. All right, then in terms of the global growth backdrop, so we've seen some continued deceleration in terms of the global growth backdrop. The German PMIs there continue to trend lower, right now at 56.9. The Chinese PMIs have ticked higher, 51.9, and the U.S. PMIs ticked up again, 58.7. That was also covered in the business cycle report. And then Japan ticking down to 52.8, so all above 50 still, which is the main point, but monitoring those developments closely. All right, then in terms of financial conditions, so they've started to ease again since this kind of corrective period that we've had in the stock market. Looser financial conditions generally are supportive of stocks. That's represented by a higher trending gray line there. They're not at a worrisome level in terms of where they are. I think financial conditions overall are generally pretty loose, and depending on what time frame you look at, they're trending a little bit looser over the past couple of months. So I'd say this is neutral to positive as a backdrop for the equity market. In terms of the market breadth, so just a reminder on this chart, I only take breadth readings on this at new bull market highs. The last bull market high for the S&P 500 was January 26th. 83% of the member stocks were above their respective 200-day moving averages at the time, and that is indicative of strong breadth and typically not indicative of a major market top, which would you'd be expecting weak breadth. And so that this is an indication that it's just not consistent with the history that the January 26th high would be the major market top for the S&P 500, and my base case scenario remains that we'll regain new all-time highs in the S&P 500 before the next bear market. All right, then in terms of market sentiment, so here this is the percentage of bulls, or the ratio of bulls to bulls plus bears. There are three categories on the AAII survey. There's a neutral category, and I'm just taking the bulls divided by the bulls plus bears, which is at about 60%. That's pretty neutral in terms of, or that's pretty close to the average historically, looking back over the average of this chart. So I'd say it's a pretty neutral sentiment reading, not particularly bullish or bearish in terms of the outlook, given that this is, I view this as a contrarian indicator. In other words, if the percentage of bulls was very low, that would actually be a positive sign in my view. And conversely, if the percentage of bulls was very high, that would be a warning sign. Margin debt to to the S&P 500. So the black line here is the S&P 500. The gray line is the level of margin debt, and then the lower panel here is showing the ratio. So basically, the margin debt divided by the S&P 500 as a year-over-year rate of change. And you can see that margin debt built relative to the S&P 500 into the prior to market tops, and that's absent right now, which doesn't mean that we haven't seen the major market top, or that a major market top can't occur without this buildup in margin debt relative to the index. But it is worth mentioning that with all the talk about margin debt, is that really it's just going up in line with the S&P 500, not in relation to it. All right, then this framework was shown in one of the PDFs that we published. I think the first PDF that we published on the U.S. equity market charts, and it just gives a simple framework for thinking about, again, a contrarian indicator on the markets. The conventional way of measuring portfolio risk, and I am skeptical of this approach in terms of whether it's a really good definition of actual risk or not, is to look at your portfolio in terms of the volatility of its components, as well as the correlation between among all of the components. And the idea is that your measured portfolio risk, or your measured overall portfolio volatility, is going to be lower when the individual components have relatively low volatility, and when the correlation among those components is relatively low, which is shown here that when we have low correlation and low volatility, you're going to get a measurement that suggests a low-risk portfolio, and conversely, with high correlation and high volatility, a high-risk portfolio. The issue is that in practice, this is used in a very myopic, backward-looking way, and so it tends to tell you how risky your portfolio was over the last year or over the last 2 years. It doesn't tell you anything about how risky it's going to be over the next year or 2 years. So this chart here is an effort to look at correlation and volatility with respect to the S&P 500, and so in order to do that, we need to disaggregate the S&P, and here I'm doing it, disaggregating it into its 10 sectors. These are the VIX sectors, which is, VIX stands for Global Industry Classification Standards. There have been 10 sectors going back to the beginning of this chart, up until 2016, when an 11th was added. Real estate was added as an 11th sector, and that was broken out of financials, where it had been part of financials before. But in any case, all the S&P 500 stocks are designated to a sector, and so the sectors are consumer discretionary, consumer staples, energy, financials, and so on. And so what I'm doing with this black line here is just taking the 10 measures of correlation of those sector indexes to the overall S&P 500 index. So what is the correlation between consumer discretionary and the S&P 500? And then what is the correlation between consumer staples and the S&P 500? Doing that for the 10 sectors, adding them all up, dividing by 10, and getting an average correlation. And this is a rolling correlation. It's taking that measurement on a trailing 2-year basis. And then the gray line is basically just looking at the volatility, measuring the volatility of the consumer staples index, the volatility of the consumer discretionary index, so on and so on, adding those up, dividing by 10, and giving us a reading on the volatility. It's a proxy for thinking about the equity market portfolio as in this modern portfolio theory way of the volatility and correlation of its components. So the so what of this is that when volatility and correlation are low, the portfolio risk is going to seem low. And my point is that from a contrarian standpoint, or I would suggest looking at this from a contrarian standpoint, where when those things are low, you might be cautious medium to longer term. For example, back in the last peak in 2007, volatility was pretty much at the low end of the historical range here. Correlation was at the low end of the recent range, and the equity market was fully valued or formed a market top, and then both correlation and volatility rose into the bear market bottom in 2009. And so when volatility and correlation are both at an elevated level, I would actually look at that as an opportunity to think about getting more heavily allocated to equities. So I think you want to be thinking in the opposite way to the conventional wisdom, which is largely based on the modern portfolio theory approach of measuring portfolio risk. Then in terms of uncertainty, so the gray line here is U.S. Economic Policy Uncertainty Index. The lower this line is, the higher the uncertainty, and vice versa. The higher this gray line, the lower the uncertainty. You can see at the previous two market tops, and this is as far back as the data goes, but at least for the past two market tops, they topped around times where the uncertainty was very low, as measured by this index. And you can see right now there might be still a little bit of wall of worry left to climb. And so neutral to positive on this chart. What would get me negative is seeing that gray line up around the 50 level. Then in terms of the VIX curve, so this measures basically the futures curve of the VIX futures contracts, and takes a look at whether the future implied volatility is higher than the spot volatility. If this gray area is above zero, that is the case, and conversely, if it's below zero, that means that current volatility is above the expected future volatility. And in any case, what you can see is that historically, the uptrends in the equity market, the S&P 500 here on the black line, have been really during times when this gray area has been above zero. And so we're back above zero here. We have been for several weeks, with a couple of dips below here. But the point is that this setup in terms of the VIX curve is generally supportive of stocks. So overall, I'm positive in terms of my interpretation on this chart. Then just looking at calendar year returns going back to 1928. So currently, the year-to-date return is about 4% on the S&P 500. The sell-side forecasts coming into the year were for a return, the range was 0 to 10%, which is a pretty narrow range for the sell-side forecasts. The history shows that actually 51% of the years here, the returns were above 10%, and 32% of the years were below 0%. So it's actually not that common for the S&P 500 to end up with a return between 0 and 10%. It's either usually above or below that range. All right, let me stop there.